Credit to Be in collaboration with Professor Anna Costello. This will be the first in a series of technical education programs you can expect from Credit to Be. We strive to give you relevant tools for the trade. Anna Costello is the Platon and Faculty Fellow and Professor of Accounting at the University of Michigan Law School of Business. She previously served as an Assistant Professor of Accounting at Massachusetts Institute of Technology, Sloan School of Business for 4 years. Anna received her Bachelor's and Master's of Business Administration degrees from the University of Notre Dame and a PhD in Business Administration from the University of Chicago Booth School of Business. Anna is a CPA and worked as an auditor for Deloitte in Chicago, Illinois. Anna is an expert in assessing credit risk for banks and for firms in the supply chain. Her recent research studies how trade credit between supply chain partners influences firm-specific and market-wide risk. Her research has been published in leading academic journals, and she was awarded the Best Dissertation Award from the Financial Accounting and Reporting section of the American Accounting Association. She received the 2014-2015 MBA Teacher of the Year Award from the MIT School of Management. Professor Costello works strategically with Credit to Be in improving the predictive aspects of our industry payment scores and financial scores. Her recent paper, while recognizing the value of Credit to Be's trade data, was groundbreaking in identifying correlations between supplier trade, small business financing, and bank lending. Her summary research is accessible on the credittobee.com website. As a board advisor to Credit to Be, she continues to work closely with our data analytics team, including some former DMBers, and enhancing financial risk modeling for the credit community. At today's webinar, she will present her slides for the first 45 minutes and be available for 15 to 20 minutes of Q&A at the end. If you are looking for a copy of the slides to follow along today, they are available in the handout section in your side panel. At the end of the webinar, we would appreciate you taking a 1-minute survey to respond to her specific questions before signing off. Those who attended will receive a copy of her slide deck as a follow-up. Following this webinar, Professor Costello will be available for follow-up questions through us at Credit to Be. Anna, I now pass it off to you.
Great. Well, thank you very much for the introduction, Roxanne, and it's a pleasure to host this webinar today, the first of hopefully a couple of webinars that I'll lead through Credit to Be. As Roxanne had mentioned, I am a professor and I teach financial accounting primarily to incoming MBA students. My area of research expertise focuses on understanding credit risk, excuse me, both from the perspective of a lender, a bank, and from the perspective of a trade creditor. So the information that I'll focus on today anchors in both of those two areas that I focus on. So before I begin, I just wanted to give you all a brief guideline agenda of what I hope to cover in today's webinar. I might not get to all of the information here, but I hope to at least touch on each of these areas. The first thing I'm going to start with is I'll start with a brief overview of the financial statements. And I think, as was in the description of this webinar, the focus of this webinar is going to be more for people who have at least read financial statements before, have some exposure to financial accounting and some understanding of the jargon used in reading financial accounting reports. So this is targeted more for a slightly more advanced audience. At a later date, potentially this fall probably, I will be doing a webinar that focuses more on very introductory accounting principles, understanding more definitions of what assets and liabilities are, understanding how to read the income statement, and so on. And so the primary focus today is going to be a more advanced focus, so I'll only briefly touch on the overview of the financial statements. Second, I'm going to talk about a brief introduction to financial analysis, and I'm going to focus today primarily on understanding ratio analysis. Third, I'm going to really focus the presentation on the perspective of the creditor. So what types of financial accounting tools can we use to better understand the credit risk of potential borrowers? And then finally, I'll talk about some limitations in using financial some things that we as users need to be aware of, and then potentially I'll talk about other sources of credit information outside of the traditional financial statement analysis. Okay, so this picture it represents how financial accounting statements are made. In particular, we have a certain set of economic events that affect the firm. And by economic events, I mean things like transactions with customers and suppliers, payments to employees, purchases of investments such as long-term assets, things that we view as bringing value to the firm, and potentially some liabilities such as a chemical spill or an oil spill. And all of those events that I just talked about impact the value of the firm. And so what financial accounting tries to do is say, let's take all of these economic events and accumulate them together into a set of statements that we can all read as users. These financial statements try and take these economic events and translate them into numbers that we see on the financial statements. What you see here in this box at the top is that management uses principles and judgments. And I think this is actually a really important point here. And that's that accounting is not a hard and fast set of rules where each transaction has a rule. Managers just have to look at that rule and understand it, and then they know exactly which number to spit out on the financial statements. Instead, the principles are kind of big picture guidelines that managers have to use and interpret in each scenario, in each economic event. And so what that means is managers end up using a lot of judgment in interpreting the principles in order to create the financial statements. And so I'm going to talk about this a little bit at the end of the presentation, but this gives rise to certain caveats and just certain things we should be aware of as users that may limit our ability to draw really strong conclusions from reading financial statements. What you see at the bottom box here is that financial statements, the purpose of these financial statements is to communicate the information that we have within the firm to its external users. And there are many, many external users. There's equity holders, there's lenders, there's customers and suppliers, and there's potential competitors, to name a few users. And so financial statements are trying to kind of please a number of different groups of people, and they can't please everybody all at once. So this is another caveat we want to have in mind, which is that some pieces of information are going to be more relevant for a certain set of users than they are for another set of users. Okay, again, I'm going to assume that most of you are somewhat familiar with the financial statements, so I'm just going to briefly talk about this. There are 4 primary financial statements, 3 of which we really find useful for financial statement analysis: the balance sheet, the income statement, and the cash flow statement. And the important thing to take away from this slide is that each of these statements provide very different pieces of information. So I often come across people that use financial statements, or some of my students, and they think, well, one statement is really enough. It's really, just important to understand cash within a firm, so they really only look at the cash flow statement. But in reality, each of these statements tells us something very unique and very different about the firm, and you glean the most amount of information by using all of the financial statements together. So the balance sheet, for example, tells us what is the financial condition of an organization on a given day. And what we mean by that is the balance sheet is a snapshot in time that tells us how many assets the company has, liabilities, and equity. So it's really a culmination of all of the asset, liability, and equity transactions for the firm throughout the life of the firm. In contrast, the income statement and the cash flow statement tell us how an organization performed over a given period. So, for example, over a year or perhaps a quarter. The income statement tells us how much value did the company create during a given period. The cash flow statement tells us how much inflows and outflows of cash came into the company over a given period. Okay, so to briefly review the balance sheet has to balance, and we have assets equal to liabilities plus shareholders' equity. And what this is really telling us is, what do I have on the left-hand side? That's your assets. And where did I get it? So did I get it through borrowing from lenders, or did I get it through contributions from shareholders? And this is really just giving you more information about what I just said. Your assets are what you own, your liabilities are what you owe, and then you'll often hear equity referred to as the residual value of the firm, or you could hear it referred to as net worth or book value. Okay, so I have the definitions in here. I don't want to spend too much time on it. One thing I do want to point out is assets are future economic benefits. So when we start to think about using ratio analyses, your assets are what's going to generate, what the firm expects to generate in terms of benefit into the future. That's a requirement that a firm must meet in order to record an asset on the balance sheet. So that's a really important component of the balance sheet, is understanding what assets the company has, because that tells us more about what the value in the future is going to be. A liability is really the opposite here. It's a probable future economic sacrifice. In other words, you owe another party, the company owes another party, perhaps a lender, perhaps a stakeholder that has sued the company, but you owe them something in the future. So that means value is going to decrease in the future. And again, shareholders' equity is just the residual between the two. If we move briefly to the income statement, net income is made up of revenue minus expenses. And so what the income statement tells us is what came into the firm, and then what did we have to use up in order to get that value. So what costs did we have to incur to get that value? Revenues are inflows, expenses are outflows. And the one thing I want to point out on the income statement is firms in the U.S. and international firms following IFRS follow the accrual basis of accounting. And so on your income statement, it's not necessarily, it doesn't follow the cash basis. In other words, I can record a revenue even if I haven't received the cash associated with that revenue. So take, for example, you make a sale to your customer and you allow that customer to pay you at a later date, maybe 30 days down the road. You can still record it as a revenue because it has increased the value of the firm. When that cash is collected 30 days later, that is recorded on the cash flow statement, not on the income statement. So you can start to see the difference here between the income statement and the statement of the cash flows, and why it might be important to use both statements in order to draw strong conclusions about the health of the firm. All right. So that was all I wanted to say about my overview of financial statements. So now I want to move to doing some financial analysis. So what's the purpose of financial analysis? Well, financial analysis takes our financial statements, the balance sheet, the income statement, the statement of cash flow, and in many cases other information like notes to the financial statements, and we employ some sort of framework. And we employ that framework in order to interpret those financial statements to try and infer what's the economic reality of the firm. Now, one thing you might notice is this is kind of the reversal. This picture is the reversal of one of the first slides I put up on how managers put financial statements together. Managers take the economic reality of the firm, they use those principles and their judgment in order to come up with the financial statements. But we as end users just have those financial statements. So we try and read the balance sheet, the income statement, and the statement of cash flow. And what financial analysis is doing is we try and interpret what are the economic events that are affecting the value of the firm. So what I'm going to be focusing on today is using ratio analysis to interpret the information in these financial statements. So I just put up a very small fraction of the potential ratios that individuals, investors might use to do some financial analysis on the financial statements. And this really is a very small fraction of potential ratios that that investors might use. There are many others out there, and interestingly enough, many of these ratios that I've listed are defined differently based on which company you work for, what type of industry you're assessing. And so these really aren't definitions, hard and fast definitions that we need to follow. I'll talk a little bit more about that later. But our challenge as investors is to choose the right ratios, the ones that are going to tell us the most information about the quality of the firm. And so what I like to do and what I like to advise is to say, let's start with what is the question you're interested in first. So perhaps you're a potential creditor. Your question might be, what is the credit risk of this firm? And so you might be interested in certain ratios like the leverage ratio or the interest coverage ratio or perhaps the current ratio. And those ratios answer a specific question: what is the credit risk of the firm? In contrast, you might be an equity holder and you care about the future residual value of your claim. In that case, you might care about return on equity or return on assets or some growth ratios. And so what you really need to do before you jump into just computing ratios is ask yourself, what's the question that I'm interested in answering? And that will help guide you in determining which ratios are best. There are really two techniques that we use in ratio analysis, time series techniques and cross-sectional techniques. And so time series techniques would say, let's take a given firm, in this case I have G&H Inc., and let's compute a ratio for that same firm over many periods. In this case I've computed it over 1998 through 2001. And what this allows me to do is it allows me to say, how has G&H compared relative to itself in prior periods? What we can see is they've improved in terms of ROA from the period 1998 to 2001. They've increased the return on assets. My view is that this doesn't tell us the whole story because, for example, perhaps this was an expansionary period where everyone in the economy was doing well, and so it really doesn't, the increase in ROA is really reflecting more of a macroeconomic event rather than the quality of G&H Inc. itself. And that's where cross-sectional analysis comes into play. What we can do with cross-sectional analysis is take a given company, in this case G&H again, and say let's choose a couple of companies that are perhaps G&H's peer companies or competitor companies in the same industry. And for a given year, let's compute the return on assets for these three sets of companies. What we can see here is G&H in 2000 had an ROA of 0.15, and we can see from their competitors that they did better than Robidoux, but they did worse than Fengsphere. And so this tells us something about the relative placement of G&H amongst their peer set. So I view both of these techniques, time series and cross-sectional, as providing useful information to financial statement users. A few caveats, and I mentioned a couple of these. There's really no generally accepted set of rules for computing ratios. So I've spoken to many people that work in the same industry across different firms, and for example, they compute leverage in different ways. They have a different definition of leverage, or perhaps a different definition of return on assets. And really it's no use arguing which one is the correct one because there's no generally accepted set of rules. What's important, however, is that for a given user or a given set of users, perhaps within the same firm, you use the same definition, and that improves the comparability of ratios over time or across different industries. The second caveat I wanted to bring up is ratios help direct you in your search for answers, but they do not in and of themselves provide answers. So I have many people ask me, okay, we just computed a current ratio of 0.9. Is that good or bad? And ratios don't really help you and give you a definitive answer on whether a company is good or bad. You have to put them in some sort of context. So you have to put them in the context of perhaps their peers. You have to do it relative to the same company in different years. And perhaps you have to accumulate a number of ratios together in an analysis in order to guide your answer, whether this is a high quality company or a low quality company. And in many cases, the answer to that question is still in the eye of the beholder. So ratios just help to direct our analysis, but they don't provide a definitive answer. And the final caveat I wanted to talk about, which I mentioned at the beginning of the webinar, is that managers understand that many investors fixate on certain ratios. So take, for example, earnings per share. Earnings per share has a impact on stock prices, and so managers understand this. So there may be certain incentives, not to be fraudulent, but to use their judgment in order to manipulate numbers slightly upward or downward depending on what managers think investors want. So they might use some window dressing. And so as investors, we need to be aware, as outside users, we need to be aware that there is some judgment in coming up with the numbers that we're relying on. All right, so I want to talk about do some ratio analysis here, and I'm going to start with a very common, very important ratio, which is return on equity. What return on equity tells us is per dollar of shareholders' equity, that's your denominator, that was created this period. And for value, we're going to use net income from your income statement. So that's going to tell us the value created this period. Now, it's very easy, obviously, to take these numbers from the financial statements, just to go to the income statement, pull net income, go to the balance sheet, pull shareholders' equity or average shareholders' equity if you choose, and compute ROE. So we could stop there and say, I've computed ROE. But what we're going to do a DuPont framework, which breaks down ROE into two components, the return on assets and the leverage. What you can see here is if we cancel out assets from the denominator in ROA and the numerator in leverage, we're still left with ROE, net income over shareholders' equity. Why might we split these into two ratios here? Well, it tells us a lot of information about where the return to equity holders is coming from. Is it coming from total profitability from operations, or is it coming from financing activities? So what return on assets really tells us is per dollar of assets, remember those are those things that generate future economic benefits, what's the value or the income that's being generated this period? And so it's really telling us about the profitability of firms' operations. The leverage ratio is saying, well, I can get value from borrowing. If I leverage up or if I borrow from, for example, banks, then I can generate value because I can take that money that I get from banks, I can invest it, and I can generate value from it. And so from an equity holder's perspective, generating value through leverage might be a great idea because I'm making basically somebody else, the bank, pay for the return that I'm able to get in terms of return on equity. But from a creditor's perspective, I might be concerned if a firm is generating a lot of ROE by leveraging up, because by increasing a firm's leverage, you're also increasing that firm's risk. And so the challenge here is if I were to see a firm, two firms, both of them have the exact same return on equity, and I didn't know anything else, I wouldn't know if the firm was generating ROE through ROA or through leverage. So as a user, breaking it out into these two components really helps me to understand more about the firm. And you can start to ask questions like, what is the sustainability of this strategy? If the firm's strategy is by leveraging up, at some point the firm might not be able to borrow anymore, and so it might not be sustainable into the future. All right. So we can even dive further into the drivers of return on equity by splitting out the components of return on assets. Remember, return on assets is the per dollar of asset, how much value am I able to get? How much income am I able to get? So in the same way I broke out ROE, I can break out ROA into two components. And those two components are profit margins and asset turnover. Profit margins are exactly how they sound. For each dollar of sales, how much income can I generate? So this is a function of strategies and perhaps keeping costs on the income statement low. So you may be you may have a company that has a lot of market power and is able to push prices up, and so they're able to generate high profit margins. Another way you can get return on your assets is by turning them over quickly. What that means is taking your assets and using them very, very efficiently in order to generate sales on your income statement. So you can see that these are two somewhat opposite strategies in generating ROA. Some firms might generate them through profit margins. Some firms might generate them through asset turnover. Okay. And what we can do even further, and I'm not going to spend too much time on this, is we can continue to break down each of these components. So remember, ROA is made up of profit margin and asset turnover. We can break down profit margin and say, where's the profit margin coming from? Is it coming from the fact that I have high gross profit? Or is it coming from the fact that I have high operating profit margin? And so we can continue to break this down. So it depends, again, on the research question you're interested in. But if you want to understand the sustainability of maintaining a high profit margin, then you might want to do an exercise like this where you break it down on the income statement. You can do the same thing with turnover. Remember, turnover is sales divided by assets. So per dollar of assets, how much value, how much sales are you able to generate? You might say, well, what kind of assets are generating those sales? And so you could break this out into working capital assets. This would give you a sense of what's your working capital efficiency. Or you could look at long-term assets like property, plant, and equipment and say, what is your long-term asset efficiency? So we can just continue to go on and breaking down these ratios. But I want to communicate that the main takeaway in that is trying to figure out where the value in the firm is coming from, where the value in return on equity is coming from. Because that ratio in and of itself, just looking at ROE, is not sufficient to understand where the ROE is coming from. This is an interesting chart that charts by industry where these industries stand of their profit margins and their asset turnover. And you can see a lot of these reflect what you might expect. So for example, we have groceries that have a high asset turnover. That makes sense. They have products on their shelves that they try and turn very quickly. And many times grocery stores have very low margins. And so you can see them up at the top left here. They have high asset turnover but low profit margin. That's in contrast to firms on the bottom right, which have high profit margin, so they're able to charge some sort of premium over other firms, and yet they have a low asset turnover. So these are products that they don't sell very frequently, but they sell at a higher price. Okay. So that was just a brief overview of ratio analysis. What I want to turn to now is specifically analysis from the perspective of the creditor. And why is this credit analysis important to understand? Well, we have several users that might be interested in this. We have lenders, borrowers, and then other investors. I'll include in there trade creditors, so firms that are trying to understand the creditworthiness of their potential customers. I'm going to formalize this credit analysis process into two components here. So I'm trying to figure out, for a given firm, are they high quality or low quality? And that's going to be separated into two components. The first is the probability of default, and the second is the loss given default. So if I'm standing at that line that says today, what I'm trying to do with a firm is say, I want to predict if that firm is going to have outcome 1 or outcome 2. That's coming up with what is the firm's probability of default. And obviously, because I'm trying to predict into the future, I don't know exactly what the probability of default is. The second component that I'm interested in is the loss given default. And so if the firm falls into outcome 2, where it's a low outcome state, so they have low cash flows, those cash flows are not large enough to cover the obligation that they need to settle. So you've extended credit to your customer and that customer ends up going bankrupt and therefore they can't pay you back. Then what we want to understand is the distance between the line, the obligation, and outcome 2. And that's going to give us what our loss given default is. Now the estimate we have on day 1, or today, of the loss is going to be a function of both the probability that you fall into outcome 2, so probability of default, multiplied by the loss given default. Okay. So the credit process tries to come up with these 2 components. And the objective is really to try and come up with the ability and the willingness of the firm to repay. So there's a couple of questions that are important to understand when you start the credit process. The first is, what risks are inherent in the operations of the business? So these are factors that are going to work against a borrower's ability to repay simply because of the operations of the business. The second question we want to answer is, what has management done or failed to do to mitigate these risks? And so we really want to try and understand how management has intervened. Perhaps it's an economic downturn. What is management doing to try and influence the firm's ability to repay? And then finally, as lenders or trade creditors, we want to know, is there any way we can control these risks? So is there any way we can mitigate the loss given default? And I'll talk a little bit more about these in future slides. So what we're trying to do is we have a set of potential borrowers, a set of potential customers, and we're trying to sort those customers into some sort of continuum of low risk to high risk. So I've put this into sort of a formal framework here of 5 different steps. The first is, let's assess the nature and the purpose of the loan. And these 5 steps are really relevant for any lender, not just a trade lender. So we can think about these as being used by banks as well. So we want to assess the nature and the purpose of the loan. Second, we want to evaluate the management, the company, and the industry in which the company operates. Third, we want to utilize those tools we just talked about, the financial statement analysis tools, in order to give us more answers about the quality of the firm. The fourth thing we want to do is project the firm's ability to repay and service debt. And so this is really about forecasting cash flows into the future, and it takes more of a prospective analysis, whereas financial statement analysis takes a perspective on historical accounting numbers. And then fifth, we want to evaluate the collateral, any sort of collateral that we might have a claim to. So all of these 5 steps are trying to assess the probability of default. The last one here is really trying to understand, what's my loss given default? Am I going to get anything back from the company in the case that the company defaults? Okay, so the first step is to assess the nature and purpose of the loan. And if we're thinking about this from a trade creditor's perspective, it's relatively straightforward. It's to provide time for your customer to pay you, and so the nature and purpose of the loan is rather clear. Other borrowers have different needs. Perhaps it's cyclical cash flow needs. Perhaps they have long-term needs in terms of expanding operations. Perhaps they have short-term needs in terms of having temporary operations. And so what we want to do as creditors is find out, what is the reason for the borrower's needs. And the reason for that is the nature of the loan really has a direct link to the riskiness of the loan. So if we think about a firm that might be expanding into a new market that there's a lot of uncertainty about, that's a much riskier loan than a firm that is selling the same product they've been selling for the last 50 years, and we sort of know what the demand for that product is in the market. So from a trade creditor's perspective, you might want to think about whether or not this customer is relatively established or whether they're venturing into new products, whether they're going to use an input to create a very new product in uncharted territory where we don't know much about demand. Okay. And so one thing we can do is we can figure out what the borrowing needs from a working capital standpoint, what the borrowing needs of a firm is. We can do things like looking at their the days financing that they're going to need. And the way we can do that is by computing their days in accounts receivable. What that tells us is how many days in the year it takes for a given company to collect on their accounts receivable, how many days their inventory is sitting, how many days it takes them to pay their own suppliers, how many days it takes to convert their sales into cash, and then how many days it takes for, how many days their accrued expenses are sitting as well. So how many days it may take for them to pay their employees. And then from a working capital perspective, we can take their days financing, the number of days they need, times their average daily cost of goods sold. Okay. I'm not going to spend too much time on this, but you can, from a simple example here, this is Black Diamond, and we computed the days accounts receivable. We add in their days inventory. Remember, these are both like uses of cash. They need the cash for days accounts receivable and days inventory. They have 8 days cash, and then we subtract out their days payable. That's because they're delaying the payment. And so their total days financing they need is 207. We know they need 207 days of capital necessary. What we want to know is a total dollar value of capital that they need. And so we need to know for each day how much cash are they going to need to fund this working capital need. So a simple calculation here would just be to take the cost of goods sold from the income statement, and that's an annual figure. So divide that by 365. So on average, this particular firm needs $297 in working capital needs. So their total desired loan should be somewhere around $61,480. Okay, this doesn't tell me too much. Again, what I would want to do is potentially compare this to other firms in the same industry, or compare it to the same firm, Black Diamond, over time. And that will tell us something about how they're managing their working capital over time. Perhaps they're changing strategies, or perhaps they're far above or far below their peers in this industry. Okay, the second step in evaluating credit analysis is to evaluate management. So this is really a softer piece of the puzzle here. It's nothing more than forming an expectation about what management has done to address the risks. What we want to take into account is both idiosyncratic risks, so risks specific to that firm, and then systematic risks. So is the economy declining? Are we entering into a recession? And then those identified risks will be the guide for our financial statement analysis. Again, trying to pick the appropriate ratios that we'll do in our financial statement analysis. Some items to consider when evaluating management. Let's think about industry characteristics. So is the industry in a growth or a decline phase? What is the competition like? Is the company facing a lot of stiff competition, in which case that'll affect their pricing strategies? What is the ease of entry? So even if competition is low right now, perhaps in the future competition will increase dramatically because it's relatively easy for a competitor to come in and mimic the same business model as the firm you're evaluating. And then also consider regulatory restrictions. So perhaps they're in a regulated industry and we might have governmental regulations coming in and imposing additional costs on the firm. We also want to take into account macroeconomic events. So again, consider if this is a recessionary or expansionary period, whether or not, for example, the Federal Reserve is taking any action that will affect the firm, and then whether or not the firm has exposure to non-domestic economies. So in some of the research that I've done, I've shown that there's tremendous spillover when firms interact or have a lot of trading with companies that are located in riskier international economies. And so you might want to assess the economic quality of the firms that the countries of the firms that the company is interacting with. You also want to think about the relationship to the manager. How long have you known him or her? Is he or she trustworthy? And is there a record of performance there? So in many cases when we don't have a lot of really solid financial statement information, this is where this relationship comes into play heavily, where we might have a past record of performance where this particular borrower is really a strong payer or a weak payer. And then finally, we want to think about the governance and control environment of the firm. So do we have a lot of checks and balances in place? Does the firm have an internal control system? If so, has that internal control system been evaluated by auditors? Have there been any recent misreporting events at the firm? What is the tone at the top? This kind of guides you into thinking about things like we talked about earlier, where management has a lot of leeway in terms of judgment on which numbers they enter into the financial statements. If we have a lot of internal controls, if we have a real strict tone at the top, and there hasn't been any misreporting, then maybe we trust those numbers more than if the firm has filed amendments or misreported their financial statements over the previous years. And then finally, we want to start to look into those ratios we talked about. So I view two categories that are really important for credit analysis is profitability ratios and then solvency and liquidity ratios. So I'm going to bring us back to what we talked about earlier, which was the DuPont analysis. DuPont analysis is really about profitability. And so if we compute the DuPont analysis here, we can see that the return on assets, which is made up of profit margins and asset turnover, tells us about the effective management of operations. Whereas the leverage ratio, assets over shareholders' equity, tells us about management's effective use of financing. So I view this as really an important ratio, even from a creditor's perspective, in understanding the sources of value generated by the firm. The other ratios you want to pay attention to obviously answer the question, will I get paid back? So we want to think about solvency and liquidity ratios. Solvency tells us about an obligation and our availability to pay, and coverage tells us about we have some flows and what are our obligations, can our flows cover those obligations. So common coverage ratios are things like interest coverage, so we would take earnings before interest and taxes, and that's what we have available. Is it enough to cover our interest expense? We also have fixed charge coverage or cash flow from operations to total debt. All of these are trying to answer the question, do I have enough resources to meet my obligations to my lenders? We also have liquidity ratios, which are more short-term in nature, and so these might be more relevant if you're considering a trade credit claim. So we have current ratios, quick ratios, cash ratios. All of these are trying to assess, let's look at our short-term obligations, so that's why we use current liabilities in the denominator, and let's see if we have enough liquid assets in order to meet those obligations. So the numerator changes here, but all of them are trying to assess the liquidity of the asset base. So you can use all current assets, or you can use the most liquid current assets, such as cash, accounts receivable, short-term investments. Okay. All right, step 4 I'm not going to cover during this webinar, but this is really where you predict the future of the firm. And so we might want to take a forecasting role, predict future cash flows, and find out or come up with, not an absolute, but some uncertainty bands on where we believe the firm is going to be in, say, a year or 2 years or 5 years. And in doing so, you can better assess the probability of default because you can compare that future value to the value of the claim that you're holding on that borrower. Step 5 involves evaluating the collateral. So collateral is really what you as a creditor might have a claim to if the borrower defaults. So if the borrower defaults, perhaps you can go repossess the goods that you've provided. One thing you want to make sure you question is, can the collateral be repossessed? If so, can you resell that collateral? Do you have an existing customer base that values that collateral so you can resell it easily? If so, at what price? Do you take a loss on that resale, or can you sell it relatively quickly at a equal price? You also want to question whether or not you have reclamation rights and how long that process might take. And one thing you might want to look at is whether or not there's any current claims on the property through the Uniform Commercial Code. Okay. So let's put this all into practice. So I've given you a lot of tools here. I've talked about a lot of different methods. What if I just want to make a credit decision? What are the kinds of things I can do? And so I've come up with 5 different things here, but there are other methods you can take as well. The first is we might want to run regression analyses to identify the most important financial ratios. So I only touched on a very few number of financial ratios. What I might want to do is say, let's take as many ratios as I can come up with and see how many of those really impact bankruptcy. And this is really related to the second method here, which was done by Altman, and it's the Altman Z Score. So you can rely on this Altman Z Score, this previous model, to come up with a prediction of default. You can use an option pricing model to predict default. You can rely on other sources. So for example, you can rely on the credit to be R score or credit to be information that provides an opinion about the creditworthiness of the firm. Or number 5, you can use a combination of all of the above. So I'm only going to talk about a couple of these methods. The first is, let's say you want to create your own machine or your own number of weights. One way you might do this is say, well, I really want to predict the probability of bankruptcy. So what you would want to do is identify a sample of bankrupted firms and then match it to a sample of non-bankrupt firms. You would want to make that match as close as possible. So you might choose firms within the same industry, the same size bracket, etc. So you have a control sample of very similar firms. And then we can look at how the probability of bankruptcy is related to a wide array of various financial statement ratios. So take, for example, this graph, which looks at various profitability measures. We have net income over equity, EBITDA over assets, so on, and looks at it relative to the probability of bankruptcy. What we can see here is that for firms with in a high percentile of profitability, so those on the farther right, have a lower probability of bankruptcy. And those with low measures of profitability have a higher probability of bankruptcy. So it appears at least that there's some correlation between the current profitability measure, or a 5-year cumulative probability, the current profitability measure and the 5-year cumulative probability of default. You can do the same thing with other types of measures. So for example, leverage and coverage, there are some measures of leverage that appear to be pretty strongly correlated with the probability of bankruptcy. And size, in contrast, doesn't appear to have a huge correlation with the probability of bankruptcy, with the exception that very large firms generally have a low probability of default. Another method you can use is just rely on the Altman Z Score. I'm sure you're all aware of this, this method or this score. What Altman did was he basically ran a regression of various components and found what the weights on each component would have to be to have a high likelihood of predicting bankruptcy, or to fit the model to predict bankruptcy. And then he suggested some thresholds. So a firm is likely to go bankrupt if Z is less than 1.81, and the firm is likely to remain solvent if Z is greater than 3. There are a couple of really significant limitations, in my view, with the Altman Z Score, which is it was estimated for a very specific set of companies. It's based on very, very old data, and you know, firms change and probabilities of bankruptcy change. And it also treats negative working capital as a bad signal. And so Altman Z by itself is, I would say, is not a sufficient statistic in determining bankruptcy or default, but it could be used in conjunction with many other methods, and it might be useful. Okay. What if you say, I'm not confident in my ability to predict default? So all of these methods, maybe I just don't have really reliable information here. So what you might want to do is just minimize your loss given default. And so we can try and minimize that line there between the obligation and the outcome number 2. And so we could impose credit limits. We could make sure that we have the right to some collateral. If possible, collect from these customers very quickly. And if you have these at your disposal, you might impose some penalties for late payment or alter the pricing. Okay. Finally, I just want to talk about some limitations in what we've talked about today. I've touched on this a little bit, which is that financial statements involve a lot of bias and a lot of judgment, and so we have to be careful in relying strictly on financial statements in informing our opinion. This is where I think a lot of relationship data or information you might have about a given manager or a given firm just through your daily interactions or your peers' interactions with them come into play. And that helps to mitigate some of the concerns we might have with the significant bias and judgment that's being used in computing financial statements. The second thing is GAAP numbers and GAAP is generally accepted accounting principles. They give us understanding of the aggregate view of the aggregate picture of the company, but there's a lot of details that are lost in this aggregation process. So my advice here would be, if you want more details, the notes to the financial statements have a wealth of information. The cost, of course, is you have to go digging for it. So you can get information about, for example, same-store sales and other really detailed information from the notes to the financial statements that are not necessarily in your income statement, balance sheet, and cash flow statement. And then another limitation is for a large set of firms, there's no financials, or they have unaudited financials. So for the firms, you really need to know their creditworthiness. Perhaps you don't have access to really reliable financial statement information, and so you have to rely on other sources to come up with a good credit risk. Some alternatives, as I said, you can dig into the notes to the financial statements to get things like same-store sales, available seat miles for airlines. A word of caution, all of that information in the notes shouldn't be used as a substitute. Much of it is unaudited, and so if possible, you use it in conjunction with the financial statements. When you don't have access to any financial statements, some possibilities are you can ask the firm for tax returns. You can pull a credit report on the manager himself, his or herself. You can rely on peer experiences, and of course, last but not least, if you just can't assess the probability of default, try to the best of your ability to limit the loss given default. Okay. So in summary, financial analysis is a very useful tool to try and form predictions on credit quality. One main takeaway I would say from today is there's really no set formula you can employ. You can't use one single ratio. You can't use one firm, one ratio. You have to look at many ratios, many methods, and compare across firms. And then finally, we should interpret financial statements with caution. Last, before I end here and open it up to questions, I again wanted to mention that I'll lead another webinar this fall that covers just basic introductory information for financial statement novices. So if you have colleagues that don't have a lot of experience reading financial statements, this would be more targeted towards them. And I would say just watch out for an announcement from Credit to Be for when that might be. And then second, I also wanted to offer up that I do customized executive ed courses. Those courses are tailored specifically to your company and your employees. We keep the class size really small, and it's typically hands-on, and you guide exactly what the need for that class is. If you or your company are interested in this executive ed course, please go ahead and contact me at my email address listed here. And I'll go ahead and stop there and open to questions.
All right, Anna, you ready for your first one?
Yes.
How is a bank's assessment different from a trade credit?
So it depends, again, going back to the purpose of the loan. So a trade creditor typically has a single purpose for that loan, which is to provide time for your customer to pay. Whereas a bank has many purposes for that loan. Many borrowers rather, apply for a loan for working capital purposes, but they might also apply for a really long-term loan for a long-term capital project. They may just be refinancing or reshuffling their capital structure. And so typically, remember, the purpose of the loan determines the overall risk of that loan. And so a bank lender might face very different risk from a trade credit lender. Further, on average, bank loans are much longer in duration in terms of the time to repay the principal on that loan than a trade credit loan.
Great. Question 2. Where do you get prospective financial information on public companies? Is it published?
It is not. So it is not mandatory, I'll put it to you that way. So if you want prospective information, if you want to project out, typically that is done by the financial statement user. So you would have to do some sort of cash flow projection over the next year, and you might do that based on historical data or how the firm is doing relative to peers. Sometimes firms will provide some prospective information in their financial statements. So you can look, for example, at future obligations on leases, which they oftentimes disclose in the notes to their financial statements. You might also be able to go to the company's website, in which case some companies do produce some prospective information. What's important to understand is that information is not audited, so it's purely based on the assumptions that the managers make in trying to determine what those numbers might be.
Great. Question 3. Are there any good public sources for industry benchmark formulas?
Industry benchmark formulas. I'm not sure what the question means by industry benchmark formulas, except for maybe, let me interpret it this way, perhaps a good set of peers, so who to compare the ratios to, in which case you can do very simple things like SIC codes, or in many cases a firm will disclose in their financial statements who they view, so who the manager views their closest peers to be. Most firms do this, most public firms do this. But in terms of industry formulas, I'm not certain how to interpret that question, so whoever asked it, just send me an email to clarify.
Okay, question 4. How much emphasis should be put on a company's deficit net worth?
On a company's what?
Deficit net worth.
Deficit net worth?
Yes.
Deficit net worth. I would say that it depends. Again, we want to see if this is a current year thing, if there's a one-time transaction, perhaps discontinued operations, for example, that is driving it, in which case I wouldn't put too terribly much emphasis on it, or I would try and at least understand what is the transaction that is driving that deficit. Alternatively, if it's something that's persistent, then I would put a lot of emphasis on it because it's something that's likely to project into the future. But again, I would like to bring it back to, it depends on, as a user, what question you're trying to answer. If you're interested in very, very short-term performance, then anything that's reported in the short term is relevant. If you're interested in longer-term performance, so projecting into the future, then I would say we need to understand what's driving the deficit.
Question 5. How do you determine total debt, principal and interest? Is it simply total debt from balance sheet or from cash flow from financing activities? Which is the best indicator?
Again, it depends on the question you're asking. So if you're thinking about a leverage ratio, I would go to the the balance sheet, and you need to first understand what is the debt I'm interested in. Is it short-term obligations, in which case I would pick apart that balance sheet and say, let's think about current liabilities only. If it's all obligations, I would take total debt from the balance sheet. If it's long-term obligations only, then obviously I would take long-term debt only.
Okay, next question. What type of ratios do you recommend specifically for credit analysis?
So I talked about this a little bit in the webinar, in the slides. I would say it's important to understand, in order to project that probability of default, I would try and understand the profitability ratio first, which is going to tell us the source of the future value. Where is it coming from? Is it coming from return on assets, or is it coming from asset turnover or profit margin, or is it coming from leverage? But then for a creditor specifically, I would say pay very close attention to those solvency and liquidity ratios, which are going to tell us specifically about the borrower's ability, at least based on the current information, their ability to pay the loan back.
Next question. Does cash and equivalents be a measure to determine the credit limit requested?
Can you read that again, Roxanne?
Absolutely. Does cash and equivalents be a measure to determine the credit limit requested?
I think are cash and equivalents a determinant for the credit limit requested? Is that what you said?
Correct.
I would have to, I don't know really why. I guess one way to look at that is that's the very, very liquid portion of the assets, and so that goes back to evaluating the loss given default. So cash and cash might tell you as a potential trade lender what the firm has immediately sitting in the stock of their cash that they could pay out to you in the case of a default. So it would be perhaps one useful component in trying to come up with a credit limit.
Okay, final question. Are there any alternatives to the Altman Z Score?
Not great ones. I listed a couple in the slides here. In terms of a model that has predictive weights, this is really still what's being used, surprisingly, given that it's based on old data. Again, it still predicts bankruptcy to a fair extent, and so I can see it being useful. But other methods you could use is trying to do, depending on the size of the firm, you might be able to use like a Black-Scholes pricing model, which is a little bit more sophisticated way to get at loss, the probability of default for that firm. You can also, use your own ratio analysis and try and, come up with an Altman Z Score model on your own. But otherwise, there's not really a available, ready-to-use model similar to the Altman Z Score that's just been updated.
Great. Well, with that, we are going to close today's webinar. I would like to thank you, Anna, for taking the time to present to the group, and thank all of our attendees for taking the time out of their day to join us. Thank you all again, and we look forward to seeing you at our next webinar.
Thanks.